As to a silver squeeze, I am not one of those who believes that there's been an ongoing conspiracy to depress the price of silver over time. Mm-hmm. I worked for great big financial institutions, and the idea that they would take a negative carry, a short position, over 10 years or 12 years, which affected quarterly cash bonuses, the probability of that occurring is nil. Wouldn't happen. Markets, all markets, are manipulated in the short term, and they're manipulated in whatever direction is easier to manipulate. For 40 years, you have manipulated silver markets down because that was their natural direction. I remember the 1970s when trading desks would manipulate the price of silver up because that was the easiest direction. The manipulation takes place because the futures markets, the paper markets, often trade 200 times the available silver to cover on a daily basis. They're much more liquid. So the game works like this. A short syndicate gets involved over the last 40 years short in the futures market. 6-year duration, 12-month duration, 24-month duration, that kind of thing. And they get what would be for you and I massively short, $2 billion short, $3 billion short, in a market where the nominal value of the positions is $400 billion. And then they borrow $50 or $60 million worth of bullion, and they pound it into the market physically at whatever point in time the market has the least volume. Right. And they use the impact of the physical market on the futures market to cover their shorts and pay off their physical loss. I mean, you see it happen time and time and time again. I don't think that there's any evidence that supports long-term price manipulation. I think that there's an aggregate of short-term price manipulations. The Eurobond market has been manipulated. The Euro market's been manipulated. The U.S. Treasury market's been manipulated. If you can manipulate markets that are that big, the silver market's a piece of cake. What'll change, Kerry, is that the easiest way to manipulate the market is going to go from down to up. The people who are involved in complex hedges in the silver market, I think, are going to get massacred. I mean, I think they're in for some truly religious experiences, to the extent that a short position on silver that has been put in place by algorithms that are looking at silver markets over the last 40 years, those leverage guys are really, truly in for a world of hurt. Long-term capital management worked until it didn't. It was a convergence trade, but the convergence trade wasn't set up for a third standard deviation anomaly. And I think the silver market is going to see a third standard deviation anomaly, which means that the people who are using silver as an unhedged corollary to some economic bet, and they're doing it from algorithms that are based on 40 years of trading history, they aren't prepared for a hiccup, and they're going to get a hiccup. Let me answer that in parts. My experience has been that in precious metals bull markets, gold leads. And when gold's momentum attracts the generalist investor into the space, leadership transfers to silver. Whether we're there or not, I don't know. What I do know is you won't need to tell me when it occurred. Usually pretty dramatic events. I've seen them happen 3 times before in my life. And you don't need a weatherman to tell you which way the wind blowing when that happens. I don't know if this will be more successful than the decade of the 70s was. But coming into the decade of the 70s, I didn't have much experience and I had no money. What's different is that I have both now. So I suspect that I will come out of the next 10 years much better than I came out of the decade of the 70s. And I came out of the decade of the 70s pretty well. Frankly, I'd buy more knowledge. I know that's not the right answer, but your best asset at age 30 is compounding your knowledge and working on your reputation. I suspect that what an investor might do, assuming they have no other assets, looking at the next 10 years, is to begin to save systematically and save probably half of what you save in gold. I say that not because gold will necessarily outperform other assets, but I think that over the next 10 years, the purchasing power of the US dollar will decline by 75%, and that gold will maintain at least its nominal purchasing power, which means that it is a high probability savings instrument. That's a boring answer. I'm tempted to say that a 30-year-old who believes that he or she will be able to increase their disposable income over 10 years if they're looking at investments simply as investments, should consider buying ExxonMobil. I would agree with that completely. Knowledge is an asset. Well, you can lose it, but it can't be stolen. It can't be taxed. The fruits can be taxed. And your reputation, the same. What 30-year-olds need to focus on is the group of people they choose to be their community, because you become the sum of your friends. Your reputation, because if you lose it, it's very difficult to rebuild it. And your knowledge. All the risks that you face, Carrie, probably are manageable if you manage the risk that's to the left of your right ear and to the right of your left ear. $35 billion is a lot to you and me, but the notional value of derivatives is more like $5 trillion. I'm not so concerned about that. I'm much more concerned about things like unfunded entitlement liabilities and the imbalance between the nominal and the real interest rates. I mean, if you want me to scare your audience, Carrie, I can really, truly do that. I'm less concerned about the impact on Wall Street and the derivatives markets by a silver short. I think it'll be, I think there's probably a couple of quantitative hedge funds that'll go broke. Good riddance.
No one cares about them anyway.
Yeah. But, the derivatives market is truly vast. There are other counterparty scenarios that scare me a lot more. If Ma's and Pa's in the United States that own high yield ETFs, junk bond ETFs, get a whiff of the beginnings of a credit crisis like they did in 2008 around real estate, and they go to sell those high yield ETFs, the ETFs are extremely liquid. They trade billions of dollars a day, but they're comprised of assets that are totally illiquid.
Yes.
If they redeem the ETF and the manager has to sell the bonds and can't, that's a scenario that's truly scary. Carrie, in shows like yours, where there's live Q&A, I've talked to investors that held high-yield ETFs that didn't understand that the assets were comprised of junk bonds. They just looked at the cover yield, not how the yield was generated. When I was a younger man, I wasn't a young man, but in the 80s, I was pretty active in the high-yield credit market because I understand how to read bond covenants. And I remember that when Drexel Burnham started to blow apart and blew apart the junk bond market, we had a description for these illiquid bonds. We called them owl bonds. And we called them owl bonds because when you called your broker to sell, your broker would say, "To who? To who?" It's a great, great, great market if you understand it. The oil and gas industry junk bonds in the 80s and the 90s made me, relative to my net worth, a large amount of money. I'm forever grateful. But I understood about oil and gas, and I understood about covenants. I remember buying bonds with a cover yield of 12% that were selling at 60. I got a running yield of 20% and a yield to maturity of 35% in a debt instrument. Life doesn't get better than that. But that's not what's on offer today. Well, it's important to understand that the Green New Deal wasn't really about environment. Let's get that out of the way. And I also need to say I'm no particular fan of Trump. But I do note that he has been effective at rescinding executive decrees by prior administrations. And I have noticed myself a real change in the politics of the regulatory agencies, which means frequently in the regulatory agencies, there was a belief at the staff level that resource projects should go ahead. But the politics of the agency were such that at the very least, stasis was what you expected. Now at the BLM, which by the way, has really competent technical people working there.
Oh yeah.
They've been hidden well for 20 years, but they're there. Now there is an incentive within the organization to get stuff done. They can use the knowledge that they have in the agency to complete the regulatory process in a responsible manner. It's further to what you say, Carrie, mining, looked at empirically, is an efficient use of land. You generate an awful lot of economic activity and an awful lot of consumer utility by despoiling a very small piece of earth. The Resolution copper mine in Arizona, when it's built after 27 years of permitting, will have substantially less environmental disturbance than one golf course. Golf courses are green, and people like to play on them. So they're regarded as not being environmentally deleterious. But if you have a monoculture, which is to say grass, in a riparian area, the truth is that they're environmentally extremely dangerous. It's important to look at the concept of environmental degradation from an empirical, technical lens as opposed to an emotional and narrative lens. And I think what Mr. Trump has been able to do at the regulatory agencies is allow them to return to empirical rather than political or narrative analysis. What I would like to see Mr. Trump do, and he won't do it, by the way, but what I'd like to see him do is require upfront bonding, environmental bonding, for resource development in the United States, including exploration, which means that the company would need to propose a reclamation budget, which the regulator would accept, and that would need to be funded upfront by way of an insurance policy. What happens right now is that the risk is socialized. People promise to reclaim, but you know what a promise is worth, particularly for a bankrupt company. It's worth nothing. The best way to ensure environmental compliance would be for the company planning to do the mine to convince the insurance company to take the risk and pay them the price for the risk that they assumed. That lets the taxpayer off the hook. Then the regulatory process comes to be involved in prohibiting the discharge of deleterious materials from the mine site to the environment. Stop. That's what I'd like to see Mr. Trump do. That's not what he will do. What he will do will be to solicit campaign contributions and political favors from elements in society like the oil and gas industry that he thinks are more aligned with him than the other side, which is to say, carry the old saw that Mencken had about elections being advanced auction of stolen property. First, both Democrats and Republicans in equal measure.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers, but physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming. Young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation, silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.